You pay your fund manager even when they lose you money. What if you only paid them when they actually performed? This isn't a theory. It's a new SEBI proposal that could completely shake up the entire mutual fund industry. Let us deconstruct this performance-linked fee, show you the good, the bad, and the critical flaw that most investors are missing. The problem is simple. Your fund manager's salary is guaranteed, but your returns are not. Their fee, the total expense ratio or TER, is a fixed percentage. They get paid for participation, not performance. We have all seen it. Your fund is up 8%, but the Nifty is up 14% and you're still paying that full 1.5% fee, further reducing your returns. SEBI's new proposal attacks this directly. It would allow funds to offer a voluntary performance-based fee. Basically, if they underperform, they are forced to charge a lower fee. It's skin in the game, and on paper, it's an investor's dream. So, is this the revolution we've been waiting for? The dream is obvious. It forces accountability. It finally aligns the manager's paycheck with your portfolio. It's meritocracy. Now, here's the reality. First, it's an accounting nightmare. A mutual fund is a pool. People enter and exit daily at different NAVs or prices. How do you fairly calculate the performance fee of a mutual fund with thousands of daily SIPs? It's a logistical black hole. But the real danger isn't just the math, it's the psychology. What happens when you tell a fund manager, perform, or you don't get your bonus? You don't get careful long-term strategy. You get reckless risk-taking. Imagine it's December, your fund manager is lagging the benchmark by 2%. Do they protect your capital and stick to the plan? Or do they take a wild, high-risk gamble on a few stocks to hit their bonus target? This proposal could accidentally turn long-term fund managers into short-term traders, gambling with your money just to juice their own paycheck. It's a massive conflict of interest. You see, SEBI's intention is right, but the execution is a minefield. The good news, you don't need to wait for this proposal. The solution to high fees and bad performance is already here. This is your 30-second action plan. Open your portfolio. For your top 3 funds, ask 2 simple questions. Am I in a regular plan or a direct plan? Know that you are paying extra fees in a regular plan, which becomes the agent's commission. Second question, has this fund been beating its benchmark over the last 3 to 5 years? The answer is probably no. So the solution isn't some complex new fee structure. It's switching to direct plans and low-cost index funds for most cases. Stop waiting for the rules to change. Just start paying attention to the details. See you tomorrow.